Hello and welcome everyone. This is a video in the series around the guest speakers, the guest commentators in our latest book, Mastering Private Equity. It is a real pleasure to have two senior partners from Pantheon in the room here with me. Welcome Helen Steers, who is a partner at Pantheon's European investment team and co-manages Pantheon International, together with Charlotte Morris. Charlotte and Helen, welcome to the podcast. Welcome to the recording.
Thanks for having us. Thank you.
Of course, thank you very much for writing a wonderful guest chapter for the book, talking about unlocking private equity for all, with a particular focus on listed private equity. And on that note, let's begin with the obvious contradiction. What exactly is listed private equity and how much should it be part of a portfolio?
I mean, it is the obvious question. So private equity obviously is the investment into private companies. And listed private equity provides a way for any kind of investor to buy a share, but get access to what at the underlying level is exposures to private companies. And there are three flavors of listed private equity that you see. One is where a private equity manager has made public their management company. So essentially, you could buy a share to have exposure to a private equity manager's management companies. That means the fees and performance fees that the manager generates. What's more common, and what we have as a vehicle at Pantheon, and is most of what we'll talk about today, is where a public vehicle gives you access to a portfolio of underlying private companies. And within that, there are two flavors. So one is where a private equity manager lists a vehicle. So through that, you would typically only get exposure to that specific manager's companies and assets. And what we manage is Pantheon International is a diversified private equity vehicle. So again, you're buying a share in something that is publicly traded, but at an underlying level, the portfolio gives you access to private companies across a number of different private equity managers globally. You know, if you take a step back and think about why that would fit in somebody's portfolio, most of what your average investor, and certainly at the retail end, individual investors will invest in, tends to be some kind of publicly traded investments. And historically, private equity has been quite challenging for individuals or smaller investors to gain access to, because traditionally, it was structured around 10-year vehicles where you needed to have quite a significant commitment ticket that you were making to that fund, and your capital would be locked up for a 10-year period. Why it's interesting having listed private equity, though, is because it allows an investor to get access to those private companies. And we'll get into talking a lot about why we think private equity is a really attractive asset class. So it's a way of getting access to those types of investment without having to have the big tickets, without having to lock up your capital for a long period of time, and with the ability to trade in and out as it suits a particular investor.
I mean, you titled your guest comment, Unlocking Private Equity for All, or what I hear very often is the democratization of private capital. So what does that mean to you, and maybe how far back has Pantheon started to create basically those vehicles? And then where do we stand today on that journey?
Yeah, I mean, so personally, I've always really believed in the ability of private equity and private investment to generate returns that can be more attractive than what you would see with public markets. I started in the industry about 20 years ago at Pantheon, and at that time, private equity wasn't really that well known, particularly amongst sort of smaller investors, individual investors, and there were limited ways to access the asset class. Pantheon, though, has had it listed private equity vehicle, Pantheon International, since 1987. So it has been around for a very long time. But over the years, that's sort of 37, 38 years now that the vehicle has been operating. Over the years, it has become better known, and there have been other vehicles that have listed offering a similar sort of exposure. So it is a growing part of the market, but there's still a lot to do. I think what's happened, particularly over the last 10 years, I'd say, is that other ways of accessing private equity have become more prevalent and certainly available to a wider range of investors. And we're sort of still on that journey. There's quite a way to go. But I think it is becoming more in the mainstream. It's certainly more on people's radar that private investment can offer really attractive returns relative to public assets of different sorts. And so I think we are getting to a point where, vehicles like Pantheon International are key to offering that access to individuals. And, we continue to spread the message and try to raise awareness about this way of investing in private companies.
Right. So 1987, wow. So Pantheon International PLC is one of the pioneers. Can you briefly share what potentially differentiates you from some of the other players, and maybe also some of the lessons that you learned over time?
Yeah, so I think, you said it yourself, we're one of the pioneers in democratizing private equity. And actually, I find it's sort of almost amusing these days because people are talking about democratization of private equity, but we were there in 1987 with an immediately accessible vehicle that anybody, any shareholder, institutional shareholders, private wealth, or retail investors could just buy one share and get access to this world of private equity. So we've been going now for 38 years, so our 40th anniversary very soon. And over that period of time, have produced pretty good return on investment. It's close to 12% over a very lengthy period of time, and that has definitely beaten public markets by sort of 300 to 400 basis points, depending on which index you take. So I think, the track record almost sort of speaks for itself. In terms of what differentiates Pantheon International, it's a global vehicle. So by buying one share of Pantheon International, you get a slice of top quality private equity right across the world, from some of the very well-known venture capital funds to buyout funds. You get access to secondaries, to co-investments, and all on a very diversified basis. So I think that is one of the key differentiators. The other key differentiator, I think, is that this is an actively managed vehicle. So it's not a download into Pantheon funds. It has an independent board of directors. So as an investment trust, there's very good governance here. Nobody from the manager sits on the board of directors. We have a board of directors, which incidentally does include some INSEAD alumni, but it's very well qualified, a lot of private equity background there. So this is a vehicle which adapts to what's going on in the environment. And just to give an example of that, when we started out, neither Charlotte nor I were there at the time in 87, but it was a pure secondaries vehicle, and it's floated with a £12 million portfolio. We now have a net asset value for Pantheon International of close to £2.5 billion. And over time, that portfolio has changed quite a bit. It started off in secondaries, we added primaries, and then we really ramped up into co-investments a few years ago. So actively managed portfolio, access to globally diversified private equity, lengthy track record, scale. So I think those are key differentiators. In terms of lessons learned, you can always be better, right? You can never sit on your laurels. So we're always looking for ways to improve performance, and that's a live topic. And I think the other big lesson learned is that, in terms of democratization of private equity, we need to be able to speak to different audiences. As a house, Pantheon has great access to institutional investors. I think more recently, trying to speak directly to retail investors is a it's kind of a different kettle of fish. So I think we're learning there. We're in the process of doing that.
Yeah, I can imagine. And access without complexity is one of the comments that you made. What makes listed private equity basically attractive compared to standard funds? And I think we can assume that the audience has an idea of the traditional GP, LP, 10-year closed-end funds. What makes it so attractive?
Well, as I mentioned before, by buying one share or hopefully a few shares of Pantheon International, you get access to a ready-made portfolio, globally diversified, high-quality private companies. When you invest in a private equity fund, well, first of all, you need to have pretty deep pockets. So you have minimum investment, minimum commitment amounts, which can vary from 5 million all the way up to kind of 20 million, depending on the size of the fund. So if you don't have that sort of spare change in your pocket, it's quite difficult to meet the minimum requirements for private equity funds. I think that's a key difference. Secondly, going into a private equity fund, clearly you have to look at the J curve. If you come into Pantheon International, it's a ready-made portfolio. There is no J curve, so that's attractive. And I suppose the globally diversified nature of it, you don't have to buy multiple positions in lots of different private equity funds. You've got a diverse portfolio right there at the beginning. And finally, access. I mean, even if you have got deep pockets, it's really difficult getting access. We know we have to work very hard to get access to the best funds. We have to find the right co-investment opportunities, the right secondaries. All of that is quite a lot of spade work. But here an investor basically gets all of that sort of immediately. I think those are some advantages.
And then adding obviously liquidity, right? So I mean, should one have the possibility to get into a closed-end fund, as the term says, so your capital will be locked up for a significant period of time, which I think is it's actually one of my biggest concerns for some of the retail vehicles being launched, that the investors are just aware of it. It doesn't make it a good or bad investment. It's just, is there enough awareness amongst the audience? And as you said earlier, it's a different kettle of fish talking to the retail audience, right? So now let's talk about kind of perception of listed private equity over the 30 years that you've been around, and NAV discount. So why do listed private equity vehicles still trade at a discount to NAV, despite kind of strong performance, good advantages that we just described, and overall portfolio quality?
Yeah, it's a great question, and in a sense, it is the elephant in the room. I think that, well, first of all, I think that the investment trust sector might be not as well understood as it could be. So, in fact, investment trusts in general over the last few years have suffered a little bit, and even the public equity investment trusts have been trading at a discount. So I think that's one thing. And then when we turn to private equity, it's a more difficult asset class to understand. In terms of valuations, trying to understand the fact that the valuations are lagging, because we are dependent on the last quarterly valuations that come from the managers. So I think that is a little bit difficult for people to understand, the lag, and then the fact that people view it as more opaque, partly because of the lag, but partly because these are private companies. And again, we've been trying to do as much as we can to make it less opaque. We're continuously improving our reports, accounts, our newsletters. We're trying to get more case studies out there, so that people can hear about the companies in the portfolio. But I do think that is a factor compared to public equities, where you can just Google, you can see it on Bloomberg. It's much easier. So I think some of that is an issue, and then I think the general sort of mythology, if I can call it, around private equity sometimes is difficult, because there is this image of private equity, of some of the bad stories that come out, We invest very much in mid-market. We don't really invest very much in these very big companies that often have some of the issues that are very well known, or indeed some of the sort of the more racy, high tech stuff, sort of bleeding edge of technology, where we're kind of boring, really,
Yeah.
aren't we? So, we kind of churn out, steady returns, mid-market, not over leveraged. But if you open some of the mainstream press, private equity doesn't exactly have a great sort of image. So I think we're continuously battling against that a little bit as well.
So some more work to be done for the educators on my side. And maybe there's a job to be done for the industry as a whole in terms of the image around it. I mean, do you see, and I think it's fair to say that, let's call it the last 5 years, we've seen just a groundswell of conversations in general around secondaries, getting more people access to it. We see that in the US, we certainly saw it in Asia as well. All of a sudden, a lot more awareness. Do you think that will help to kind of get people more interested and hopefully move the needle in terms of education and interest in the products?
Absolutely. I mean, I think, there are people that say there's no publicity is bad publicity. I think it is helpful just being, in the headlines and people getting an awareness of what private equity is. And even if it's just a sort of starting point, you read a story in financial media, and that is the trigger to make you want to kind of dig in a little bit more and find out what private equity is, what it isn't, and do a bit of that research yourself. I think the growing knowledge and awareness of private equity is really important, and it's been a great benefit for the sector. I do think also that, there are these headlines that have been out there over the years, but I think investors are becoming more sophisticated and able to look through that noise and try and understand actually why is this an interesting part of the market. And there's a lot written in the media and research that's been done around public equities shrinking and the growing private investment asset class, and within that, companies wanting to stay private for longer because they don't want the kind of the scrutiny and the challenges for growth that come with being a public company. So that too, I think, has led more people to think about private investment and just have an awareness that it's out there and that it is something that they should think about within the context of a broader portfolio. Not necessarily that they should put everything into private markets or keep everything in equities, but to have that balance and think about an allocation that makes sense to diversify the portfolio.
I mean, in an ideal world, maybe how would you advise a private individual to think about adding the piece to the portfolio? So what would be a good starting point?
I think it really depends on the circumstances of an individual. And we speak with a number of investors across the spectrum. So at the institutional end, groups that have dedicated teams thinking about what their liabilities are, what they're sort of trying to create capital growth for, all the way down to an individual that might have some time to do a bit of research around what they like, what they don't like, what might be cyclical, what's not, how to think about risk and the connection between that and the returns that they can generate. We see institutional investors typically sort of allocate between 5 and 15% into their private assets as part of a broader portfolio. But I think when it comes down to individuals, it very much depends on their circumstances. So at what stage of life are you at? Are you sort of younger and thinking about really long-term capital growth and not really wanting to sort of touch your investments early on? Or are you actually sort of much later in life where you'll be thinking about maybe wanting an income stream from your investments, or thinking about retirement and being able to just rely on your investments as a sort of source of income through retirement? That's crucial to understand where somebody sits and whether they can afford to lock up their capital for a long time, because private equity really is about long-term capital growth, and it is a long-term asset class, versus at the sort of later stage of life where you need a bit more in your portfolio that is going to be generating an income that you can take immediately. So you need to kind of bear all of that in mind. And fundamentally, that speaks to an individual's risk appetite. So again, private equity generates higher returns, but generally speaking, does take on some risk. And within different private equity vehicles, there are different flavors of that. And you need to sort of have a good understanding of that. As you mentioned before, it's really important that investors are given the full picture and understand all of the sort of considerations so that they can make an informed decision.
Yeah. Helen, you wanted to add something to it as well before. Go ahead.
No, I was just going to say as well that, as we talk about public markets, there is this sort of what I call the pacification of, public markets where, increasingly, people are investing via index funds, there's a lot of concentration in public markets. And I think that just adds to the appeal actually of private markets, because private markets are, these are actively managed. It's like super active equity. It's not equity, but it's super active equity. And you can almost think of it as a bit of a barbell. You've got, a lot of capital that is managed passively, and then you've got this sort of super active asset class. That was the thought I had there.
Yeah. So, I mean, I think you mentioned earlier on that there is basically some opaqueness, or at least the illusion of some opaqueness around the private asset class. And clearly also some skepticism around valuation and the transparency around that. Marking to market, as you said, this is not something you trade on Bloomberg. This is basically marking to model. There are some questions that remain. So can I ask you, I mean, how is it justified, number one, the skepticism? And number two, how has communication to investors changed?
I think one of the challenges, and actually one of the reasons why we sort of touched on the discounts in listed private equity, one of the reasons why discounts kind of widened out a few years ago was exactly this, that there was a skepticism around private valuations. And that came from, a downdraft in public markets that didn't mirror what happened with private valuations. So at that point in time, I could understand why there was skepticism about private valuations, because over that specific period, it felt like there was a disconnect between what happened in public markets and how managers had fed that through into their own portfolio valuations. But if you look over the longer term, what you also would have seen is that in the run-up and the kind of rally in public markets before that turned down, private valuations hadn't increased to that extent either. So private valuations, generally speaking, don't have the volatility that you see in public markets, because what the managers are trying to do is assess really what's the true value of this company and try and take a little bit of a step away from the sort of sentiment or what's going on in the macro picture and really focus on what do I think someone would value this company at. And the structure of private equity is that you hold these companies for 4, 5, maybe 6 years, and those interim valuations are just sort of guidance points along the way, because what really matters is how much did the manager pay for the company and what do they get when they actually sell that company. And that's really what the managers are focused on. What am I actually going to have somebody pay for my company when I manage to sell it? So the interim points are sort of reference points along the way. And it's a bit like valuing property. You pay for the house that you buy, and an estate agent might come around while you're living there and say, well, I think it's worth X amount today. But really all that matters is at the point when you sell that house, do you find the buyer that loves your house? They come around and they say, this is the perfect house for me. It's got all the things that I want. It fits my lifestyle. It fits my family. It fits my situation. And I'm willing to pay a bit more for this. perhaps, than the estate agent is telling me. It's a similar sort of thing with private valuations. There isn't, as you say, a sort of a share price or something else specific that you can point to that tells you exactly what that company is worth. And it is a little bit of a science, taking into account different metrics, whether that's public comparable companies or the transactions that have taken place recently, maybe even using a discounted cash flow model. So it is a reference point. And I understand why, from an outside perspective, it's difficult to really see how those valuations have come together sometimes. So there is a really sort of important need, and I think we've already been a little bit on this journey, for managers to be more transparent about how they value their companies. And we put a lot of effort into trying to convey and communicate what we love about our portfolios to our investors too, for the investment trust, our listed vehicle, but actually across all of our other traditional structure vehicles. I think across the industry there needs to be a bit more transparency about the process that goes into valuations, and we spend a lot of time doing some of that work on behalf of our investors, really interrogating what the managers have used as a valuation, what's their policy, how do they approach valuation each quarter. But inevitably there will always be a bit of a difference between private and public valuations, because the sort of the motivations and ultimately what we're trying to do has a slightly different focus behind it. And really what matters is that kind of selling point.
Yeah. And it goes back to what we discussed early on. There's really some education needed that what really matters is cash on cash returns, right? And what's in between is really just some guideposts directionally where it's going, but clearly it will also never have the volatility then that a public markets portfolio would have.
Yeah, it's one of the things that I think is also valuable to particularly retail investors about having these listed private equity vehicles, because we take on a lot of the work around that on behalf of our investors. So, and with the independent board that we have, who's also sort of challenging us on the processes that we run around valuation, sort of managing the cash flows in the portfolio, looking at how much a manager generates when they actually sell a company. How does that relate to the valuation that they used for that company before they launched that process? And then that whole process of just managing those cash flows is a really key part of what we do that facilitates investment in private equity that is challenging for an individual investor to be able to do. So when you get that cash coming back, finding a new investment opportunity to invest that capital in, and managing when are we seeing some cash flows coming back, when do we need to invest in new deals, all of that is what the manager takes responsibility for, to facilitate this sort of access to these private companies on behalf of investors that they don't have the resources to do that themselves.
Right. So let's have a little bit of a look at some of the structural tailwinds going forward and the outlook going ahead, because we're clearly at a point where I would argue there is interest, right? I mean, private equity from the days when you started in the 80s, where it was a cottage industry, if I may say so, has really grown and has gone mainstream. So there will be naturally more interest from the retail investors, now more products that will allow them to enter as well, which obviously will increase interest in the listed products as well, I would argue. And overall, I mean, shrinking public markets, right? Some of the larger investors are paying close attention to that as well in relation to private markets. So does all this package together strengthen the case of listed private equity going forward? So are you positive about the next 5 to 10 years?
Definitely.
Yeah, absolutely. I mean, I think all of those themes that you just touched on there, the biggest one is the shrinking public markets, that brings private markets much more into focus and just puts the sector on everyone's radar. But I think what's happened over the kind of evolution and maturing of private equity over the last few decades is that you've seen a lot of specialization, which means that when someone comes to think about investing in private equity, they can be quite particular about what they pursue and what kind of flavor of private equity they think is attractive. And there are different versions of listed private equity. I sort of alluded to the 3 different types at the start, but even within those different types, there are quite different strategies, even just within our space in that, where we are multi-manager and a diversified underlying portfolio. There are different ways of accessing the market and different themes. We sort of focus on sector themes in particular, looking for a more defensive set of assets, and we lean into technology and healthcare. As Helen said before, quite a bit of that is quite boring. Software, healthcare services, things that are essential. And that specialization, I think, has meant a couple of things. One is that the manager universe is somewhat Darwinian. I think the groups that persist and continue to raise capital and continue to do well are the ones that have demonstrated that they can differentiate themselves and can genuinely add value, create better companies, help companies to grow, and aren't really doing so much of what was historically associated with private equity, where it was, huge amounts of debt and just relying on the market rising. So the way that there are different sort of approaches to the market, I think makes private equity really interesting, and particularly listed private equity, it makes a really compelling opportunity for anybody out there to be able to invest, which is very different from any other kind of wrapper that is out there. So the traditional end is much more focused on the institutional investors. A lot of the recent new products have been around kind of semi-liquid wrappers or feeders for high net worth individuals, all of which still require you to have a certain level of assets and to be a sort of accredited investor, a certain type of status of investor. Listed private equity is really the only means by which anybody, literally anybody, can go onto an execution-only platform, buy shares in a company that give them that exposure. And I think as the awareness grows beyond the sort of higher-end individual investor, there is a case for that group of people to kind of come to this type of vehicle.
I mean, it will be interesting to see as the US is discussing right now to open even the retirement vehicles that they have to private capital. I think this will also then ultimately have a knock-on effect to education and chatter amongst the retail investors as well. Now, if you look ahead kind of like 5 or 10 years, I mean, what would kind of success look like for listed private equity, or how would you kind of wish the market will look like at the time?
I think for us, I mean, as we've said a few times during this interview, we think that private equity really deserves to be in everybody's portfolio. So it's a democratized asset class. It's part of equities, but it's super active equity, and we don't see why it should just be the very wealthy individual investors or people that invest in defined benefit pension plans who've been in private equity for a very long period of time that have access to this type of investment. So we think it should really be in everybody's portfolio. Charlotte said earlier, that will depend on people's appetite for risk, where they are in their lives, and all of that. But we could see this being an essential part, a percentage or 2 or 5 or whatever of really everybody's portfolio, and sort of an accepted asset class. I think in general that would be a great place to be. And then so that's for private equity in general, but for listed private equity, because of the ease of access, because of the fact that we do all the work inside the vehicle, the fact that you don't need these minimum investments, you've got access to a diversified private equity portfolio, I think should make listed private equity sort of come back into fashion again. So clearly, we would like to grow Pantheon International. It's been around for 38 years. We see a bright future for it. We think that there's plenty of growth that can come in the future. We could see a place in the future where the discounts certainly narrow from where they are at the moment. I mean, it's a ridiculous level really at the moment, and totally unjustified by the track record of Pantheon International and by what we've achieved. So, success would be I think bigger vehicles all around, a more popular sector, maybe a little less criticism in the press would be nice. Recognition that maybe private equity, really does have a place in people's portfolios. And then for us at Pantheon International, I think, continued success in terms of performance, leading to a narrow discount and a bigger vehicle.
So, and as you rightly said, with the discount right now, this may be just the right time to jump in and explore basically what can be done around that. So thank you so much. I really appreciate your time given to actually write for Mastering Private Equity, but also for giving me the time for this interview. It was a real pleasure. I'm sure you will get more interested parties calling you up after seeing the interview. And I look forward to seeing you in London. Thanks very much.
Thank you, Claudia.
Thank you.